Okay, another area that you've done a ton of incredible research is private equity and venture capital. And like I said, it's going to be a general question, so I hope it's not hard to answer. For retail investors, what do you think about private equity and venture capital as an asset class?
Um, I think that for most retail investors, it's not a great idea to invest in private equity and venture capital. And the reason is that from a lot of work that has been done over the last 20 years, and I have some very old work with Steve Kaplan that we did, but kind of what basically we see is that in venture capital and private equity, you see massive differences in the performance of funds, way more than in mutual funds or any other, kind of traded asset classes. And so it really matters with whom you invest,
Mm.
right? So it's not just, oh, I can build a diversified portfolio because the stakes are so big. If you are a small investor, there is no way you can be diversified. You need easily $500 million to be
Mm.
even close to diversified across some, kind of private equity funds. And if you really want to be, kind of in private equity, forget, ventures, the funds are a little bit smaller, but in private equity, right, you need even more.
Mm.
And so that, a retail investor cannot achieve. Now, on top of it, actually, in some more recent work that I've done with Josh Lerner, what we also saw is actually who you are matters in private equity. And this actually goes back even to the discussion we had about financial advisors, right? Which is basically the best private equity and venture capital firms will charge clients based on how valuable they are to the fund. And what we have basically seen over the last decade in particular is that if you are a really big pension fund, right, or the endowment of Yale and MIT and Harvard and so on, so you basically have a lot of money and you have some expertise and you have maybe a name brand, you get into much better funds than if you're an average person. But
Mm.
then we have shown that if you don't get into the best funds, actually the performance is worse than just investing in the index. And so that's why I think, for retail investors, it, left to their own, effect, so to speak, in their 401k, I don't think that's a good idea.
Hmm. Yeah, that's really your stuff on private equity is obviously incredible research. What do you think about? So you mentioned pension funds. What if we took a like an ultra high net worth individual investor with a big name? Maybe does that apply to them too?
So there, what we see is basically it really matters how smart the investor is. So,
Mm.
kind of there are some very high net worth individuals who have a fantastic team that, works with them, and they make fantastic decisions, and have great returns. And then others, whom don't, maybe, they don't know how to choose their own advisors, or, kind of,
Mm.
they just got unlucky, but, kind of we see a lot of differences. But we even see on the pension funds, and on the endowments. I was just saying endowments, but the smaller endowments who don't have the money to invest in an expensive staff that can really understand private equity and venture capital well enough, they typically have bad returns
Mm.
in VCPE. While, kind of um, the pension funds and endowments that are large enough and have over time invested in a good enough staff, they are the ones who have better returns.
Wow.
Let me say, one thing that I worry a lot, and sorry you didn't ask this, but
No,
this is
please,
something
please.
that really kind of, yeah, you can say keeps me up at night, but it does keep me up at night, is that you see, the nature of private equity and venture capital and the fact that it's so illiquid means that you can hide bad returns for quite a long time, right? So for 8 years or maybe even 10 years, there is no reckoning, and then there are bad returns. Now, why is this particularly bad for pension funds, but also for endowments, is because if you think about a university spends out of its endowment based on a rule, right, on the endowment returns.
Mm-hmm.
Now, if it's a publicly traded return, if your portfolio did poorly, well, then you don't spend so much, right? But in VCPE, where you can pretend that, oh, we had 12% return for 10 years, and therefore the university might overspend, right, out of its endowment. Basically, what you're doing is you're beggaring future generations in order to spend today. Now, right, if today's research is brilliant and people do a great job, well, maybe that was good. But if they don't, then I think people need to understand that we are actually de facto stealing from future generation or from the young people today by pretending that we have these great returns. And the same is true for pension funds, right? It's basically we are giving today's pensioners way more, and we're taking from the young, right? And I'm an old lady, so I'm not on pension yet, but right, I mean, but really it worries me that the more we do this, the more we're leaving the young generation to hold the bag.
Yeah, holding the bag is that. I agree with you on private market valuations. We don't touch it as a firm, so it doesn't keep me up personally per se, but I think it's pretty scary. There's an article recently in the Wall Street Journal about private market valuations and how funds acquire private assets for a steep discount to their mark, but then value them in the fund at the mark, and it looks like they just got a really big positive return, which then affects the fund's performance, which then affects investors allocating to the fund. But of course, you can't argue that's a real valuation, I don't think. Anyway, I agree. That's very scary stuff.
This is exactly, again, right, where because the illiquidity allows you to hide a lot, if people don't fully understand these implications, they are not aware that this is happening.